So, is this the most dangerous rate cut in history? This chart right next to me says that the Fed is going to cut rates with 90% certainty today. Today is December 12th. Now, here's what's fun about this. We are intentionally airing this about 2 weeks after the Fed makes a rate cut to see if this actually is the most dangerous Fed cut in history, which is the title of this video we're going to watch together from Ross Evans. Let's see. Now, what I want you to do is leave comments below on this video, particularly on this video, to let me know what happened over the last 2 weeks. I don't know. I can't see the future. Let's see what he has to say.
History is being made. The Fed is gearing up to cut rates for the third time in 2025, and the S&P 500 is still sitting just beneath its all-time highs. That's 3 rate cuts in a year without a major recession, without a financial crisis or a pandemic or anything dragging down the economy. They are cutting rates into good times, something we almost never see. And every time the Fed has cut rates, while stocks were near highs, they went up the following year. The S&P 500 has risen by an average of 13.9% over the next 12 months. And at the same time, we're experiencing one of the biggest technological revolutions of our lifetime. Artificial intelligence is boosting productivity in ways we have not seen since the Industrial Revolution or the birth of the internet itself. But AI has a downside too. It's killing jobs. November payroll data revealed that we actually lost jobs last month. And job creation has been declining all year. The unemployment rate just hit 4.4%. So what happens when stubborn inflation, a cooling labor market, and the biggest technological boom in 2 decades all collide with a Federal Reserve that keeps cutting rates? Well, let's break it down. Now, on Wednesday, the Federal Reserve will execute its 3rd rate cut of 2025. And the reason hasn't changed. The labor market is cracking. For 4 straight years, the focus has been...
Oh, that's interesting. He's using the Kalshi betting market. Okay. I mean, it's very, very similar to this, but it does track over time, which I like.
Almost entirely on inflation, but that's only half of the Fed's job. They're also tasked with maintaining stable employment. Earlier this year, we learned that last year's jobs numbers were inflated. The government revised the report, and the Fed has to cut. They have no choice. The economy needs lower rates to stimulate spending, borrowing, and investing, to let businesses breathe easier and consumers to loosen their purse strings. But inflation is still running hot. Core CPI is sitting at 3.1%. Prices are up almost everywhere, a full 110 basis points above the Fed's long-term 2% target. So inflation says don't cut, but the labor market says you have to. And all of this is happening in one of the most overvalued stock markets in U.S. history. According to Bloomberg, valuations are near higher than the peak in 1929, higher than 1964.
I don't like the idea of looking at this because value is super relative, right? We could take a look at Derpy Joker, right? We could take a look at Derpy Joker right here. And you could say, Derpy Joker was overvalued when I bought him. Look at that dude. He's ugly AF. Right. I understand. I don't want you to be a Derpy Joker. That's why we now have this as a prop. But was it really overvalued? Because maybe in a couple of years from now, I could resell it for a higher price. Or maybe in a couple of years from now, I could resell it for a lower price, right? Value is relative. Value is super relative. I don't like the idea of something being, quote, overvalued or undervalued. Because today, which is all that matters when you're making your trading decisions, today, that's the price that you're going to have to pay. Is that overvalued compared to the year before? Sure. Is it overvalued compared to a year from now? We don't know. It could be super undervalued compared to a year from now. So all we can look at is what is showing today, because that's the price the market is showing you right now.
Even higher than 1999, the peak of the dot-com bubble. You see, normally rate cuts happen in recessions, in market crashes, periods of financial stress like 2008, 2020 after COVID, but not this time. Despite the weakening labor market, GDP growth remains strong, over 3% annually. That alone is creating a fierce internal debate inside the Fed. Do they cut another 25 basis points, or do they go bigger, cut 50? Because look at the data. Consumer confidence in jobs.
Well, again, this is going to be really fun to watch in a couple of weeks, right? There's a 90% chance of them cutting by 25 basis points. I don't imagine Powell's going to come out with like guns blazing. No way.
Jobs has plunged to just 34%. That's a multi-year low. The jobs are plentiful index has collapsed 22 points in 2 years. The labor market has materially weakened. But meanwhile, inflation is still elevated. GDP growth is above trend, and AI is supercharging productivity and corporate profits. No wonder the market refuses to fail. The S&P 500 remains just a hair beneath all-time highs, still up more than 35% from the April lows.
Where we at? I'm just curious. As of the time of this recording, this is going to be such a brilliant video to put out later. I got to pat myself on the back, right? We're looking, oh, look at this. We've actually created 2 separate order blocks right here near the top of the SPY. We are super close to the top. In fact, let's see. How close are we to the top? Less than 1% away from the top. So I don't know where it's going to go, but I'm hoping personally, selfish reasons, because I have lots of trades on right now, that we blow through this order block and it continues up. And by the time you watch this, you're gonna be like, oh my gosh, we're at new all-time highs. This has been the best ever. That would be the best. I'm just saying.
Making it one of the strongest 5-month rallies in modern history, right alongside the early stages of the 2009 recovery. Now another rate cut is about to pour gasoline on the fire. Yes, valuations are stretched, but it is nearly impossible to build a credible bear case when the backdrop looks like this. You have above average inflation. Yes, it drives up housing prices and food prices, but also stock prices, bullish. 3% GDP growth, bullish. A once-in-a-generation AI revolution, hyper bullish. 3 rate cuts with more on the way. Trump appointing a new Fed chairman, heads up. He's going to be super dovish. He's going to want to cut aggressively, bullish for stocks. We have $700 billion in annual capex in the tech sector. That stands for capital expenditures. The big guys, your NVIDIAs, your Meta, your AMDs, $700 billion a year they are spending on infrastructure, on data centers, all that money pumping into the economy. The Fed just ended its quantitative tightening program. We have $2 trillion in annual deficit spending.
Now here, he's going to tell you all these great reasons, right? And also bearish reasons. You got to come up with your own plan. You got to come up with your own plan, whatever that plan happens to be.
Do I like it? No, but it's inflationary. It's being pumped into the market, and it's going to cause asset prices to rise. We also have 13% year-over-year earnings growth on the S&P 500, nearly 50% above the long-term average of about 9%. How do stocks go down in that environment? Could we see short-term volatility? Of course, Trump's in office. The market hangs on every
Yep. There could be a golden toilet tweet. That's for reals.
Post. But long-term, asset holders are being rewarded and will continue to be. Gold knows it. Silver knows it. The housing market definitely knows it. Markets are pricing in what's coming. Lower rates in a hot economic backdrop equals higher asset prices. And this is one of, if not the best long-term environments for owning gold, real estate, stocks, and other assets that we've ever seen. The third Fed cut of 2025 is here. Strap in. This bull run isn't done. Not even close. And if you
I actually thought he was going to be more bearish, but he came through with a very bullish case here. I don't know. What did you expect? Let me know in the comments down below. Were you expecting to be bullish based on everything he said? That's a bit of a surprise for me. I thought he was going to come out very bearish here. But that's okay, right? Be sure you have a plan and follow that plan. So now what's going to be great is watching this 2 weeks from now on the replay, because now we can see what happens. Now, granted, fingers crossed, please, Lord baby Jesus, let us have a huge Santa Claus rally in the next couple of weeks. That would be amazing for my stocks. But anyway, if you're looking to save time, make money, and start winning with less risk, click one of these 2 videos, and we'll talk soon.